You know, if you just glanced at the Coeur d'Alene industrial market's vacancy rate, still really sticking high at 6.3%, way above where it usually sits, you might think things are, well, pretty bleak.
Right.
But Q3 threw a curveball, a big one actually. Net absorption suddenly jumped over 80,000 square feet. It suggests tenants are definitely still out there looking.
Yeah, demand is surprisingly strong underneath it all.
Welcome to the Deep Dive. We're the podcast where we take complex source material and boil it down to the insights you can actually use fast.
And today, our focus is laser sharp. It's the Q3 2025 Industrial Market Report for Coeur d'Alene, Idaho. Our goal here is pretty straightforward. We want to pull out the key trends, maybe some surprising numbers, and what it all means if you own, occupy, or invest in industrial space there.
And just to be clear, everything we talk about today, it comes straight from that official Q3 2025 market report. No guessing games.
Exactly.
Yeah.
Strictly the source material.
We'll get you this vital info in under 15 minutes. That's the plan.
Yeah.
And look, if anything sparks a question or you need more specific context for your situation, the person to reach out to directly is Eric Peterson. His number is 509-903-9077.
Got it.
Okay, let's kick off with our quarter in a minute. 3 big takeaways that really define Coeur d'Alene Industrial in Q3. What's headline number 1?
So first up, demand. It really outperformed expectations. Q3 net absorption was, as you said, strong, 80,050 square feet.
Okay.
And that was huge because it meant the total absorption over the last 12 months, which was about 75,800 square feet. Well, finally edged out the new supply delivered in that time, which was around 61,900 square feet.
Okay. So demand finally caught up with recent supply thanks to Q3.
Precisely.
All right, so demand looks healthier. But the second headline is about supply, right? And it sounds like not much is coming.
Yeah, that's putting it mildly. The construction pipeline is severely tight. The report shows only 52,000 square feet under construction right now.
Only 52,000. Wow.
Yeah, and just compare that to the 10-year average for this market, normally around 250,000 square feet under construction. So it signals, extreme caution out there.
Okay, serious caution on the building front. And that caution maybe links to the third point, pricing.
It does seem connected.
Yeah.
Headline 3, market rents felt some pressure. Overall, asking rents dipped slightly, down 0.6% compared to last year. The average is now $10.30 per square foot.
Not a huge drop overall, but still down.
Right, but it wasn't across the board. That slight decrease was mainly driven by some softness, maybe even deflationary pressure in the more specialized industrial properties.
Interesting. Okay, so summing up the quarter.
If you remember just one thing from Q3, vacancy is still historically high, no doubt about it. But the quarter really proved that the actual tenant demand for industrial space, it's fundamentally healthy.
Okay.
The real drags on the market seem to be more about, high capital costs, developer caution, and maybe weakness in specific types of industrial buildings, not a general lack of tenants needing space.
Let's dig into that paradox right away then. Trend 1, this wrestling match with the 6.3% vacancy rate. Now, for anyone familiar with Coeur d'Alene, 6.3%, that just feels high.
It is high. I mean, the report shows it's more than double the 5-year average of 3.2%.
Wow.
And even further from the 10-year average of 2.6%. It translates to about 680,000 square feet sitting listed as available right now.
So there's a lot of space technically on the market, but the surprise, as you said, is that strong Q3 absorption.
Exactly. The high vacancy tells you there's an inventory glut, maybe. But it doesn't tell you there's no demand, especially when you look back. Q2 2025 was awful. Negative absorption, down 76,765 square feet. So that 80,000 positive swing in Q3, that was a massive turnaround. It really signals genuine tenant appetite coming back.
Does the report break down that vacancy? Is it worse in certain areas? You mentioned Post Falls earlier.
Yeah, Post Falls is definitely feeling it more. The report flags an 11% vacancy rate there right now.
11%. That's huge.
It really is.
Yeah.
And it probably points to a concentration of available space in certain building types or sizes there. Suggests the glut isn't maybe uniform across the entire market.
So who does this paradox impact most right now? Owners must be feeling the heat with all that competition, especially in Post Falls.
Absolutely. Owners are definitely facing increased competition.
Yeah.
But
that strong Q3 demand is maybe a lifeline and a good sign for tenants looking.
It's a huge positive signal for tenants, yeah. It suggests they might have some leverage now because of the overall high vacancy.
But maybe not for long if that absorption continues.
Exactly. That's the key thing to watch in Q4. Can that positive absorption hold up? Can it keep chipping away at that availability rate? If Q4 looks good too, I think investors might start feeling a bit better about the underlying demand picture.
Okay, that makes sense. Which brings us nicely to trend 2, this rent growth divergence. So overall, asking rents down 0.6% year over year, averaging $10.30. But you said that average is, well, kind of deceiving.
It really is. You have to look at the subsectors to understand what's happening. Specialized industrial thinking, like heavy manufacturing custom facilities.
Right.
That segment saw the biggest drop. Rents there declined 2.0% year over year, down to $9.70 per square foot.
Okay, 2% down there. What about standard warehousing, logistics?
Logistics was slightly negative, down just 0.5% year over year, averaging $10.10.
So pretty flat, really.
And then the bright spot, flex properties.
Flex was the only one bucking the trend. Rents there actually increased 1.1% year over year, up to $11.90 per square foot.
Wow, $11.90. That's noticeably higher than the others.
It is. And for listeners maybe less familiar, flex is often that mix of, some office space with warehouse or light production area, often used by local businesses, service providers, contractors, people serving the local community directly.
So that difference, $11.90 for flex versus under $10 for specialized, that tells a story about the local Coeur d'Alene economy itself, doesn't it? I think it absolutely does. The strength in flex seems directly tied to those local economic drivers. The Coeur d'Alene area has really robust population growth. The report mentions 1.7% annually, mostly from people moving in.
Right, that immigration.
That creates steady local demand, which keeps the flex sector humming. Meanwhile, the bigger logistics and specialized stuff, they're often more tied to national supply chains or bigger capital investment cycles, which are facing more headwinds right now. That's where you see the pressure.
Okay, so local demand is boosting flex, while broader caution is hitting the bigger boxes. Is there any good news on the rent front looking forward?
There is. The report actually projects these overall rent declines will ease up. It forecasts overall market asking rent growth to turn slightly positive, maybe 0.9% sometime in 2026.
So, suggesting we might be nearing the bottom of this rent dip.
It seems that way. And that floor might be reinforced by our third big trend, the shallow construction pipeline.
Right, back to that tiny number.
Yeah, we mentioned it, but it's worth hammering home. Just 52,300 square feet under construction in the entire market.
It feels like trying to fill a bathtub with an eyedropper, but at least someone finally turned off the main tap for new supply.
That's a good way to put it. And importantly, over half of that tiny amount, 52.7%, is already pre-leased.
So it's not even speculative building.
No, it seems very targeted. And if you break it down, Post Falls has most of it, about 43,000 square feet. But the biggest single project in there, the Secured Investment Core building at 36,800 square feet, that's not even due until September 2026.
Okay, so really not much relief coming soon. That 52,000 SF compared to the typical 250,000 SF average, that screams caution from developers, from lenders.
Extreme caution. With debt costs high and existing vacancy at 6.3%, you can see why they'd hesitate to break ground right now.
What does that mean for existing owners, though, long term?
Well, long term, this lack of new supply is actually pretty good news for current owners. It drastically limits future competition. It sort of guarantees that when demand fully catches up and that population growth suggests it will supply, won't suddenly flood the market and push rents back down again.
Okay, interesting dynamic. So construction's frozen.
Mm-hmm.
What is trading hands then? Let's look at the transactions roundup. Does the sales data also show that caution?
Oh, absolutely. It confirms the capital freeze, big time. Industrial sales volume over the entire past 12 months, only $2.1 million.
Just $2.1 million.
For the whole year?
Yeah. Compare that to the 5-year average of $7.8 million per year. It's a dramatic drop.
It tells you everything about the capital markets, doesn't it?
It really does. Big institutional players seem mostly on the sidelines, likely due to the high cost of debt. What's kind of interesting, though, is the type of deals that did happen in Q3. They were very specific, maybe high-value niche deals or strategic repositioning plays, not broad market activity.
Okay, like what? What stood out? Well, the one that got people talking was that high-price sale at 11,574 North Coeur.
Small building.
Only 5,670 square feet, sold in July for $1,542,800. That works out to for $272 per square foot.
272 are a foot. Whoa! Didn't you say the average market price is estimated around $110?
Exactly. It's nearly 3 times the average. It suggests, a real disconnect. Maybe a specific owner user just had to have that exact building or location, and there was nothing else like it available, even with a high overall vacancy. It points to scarcity in the really premium, ready-to-go segment.
A necessity purchase, basically. Okay, what else traded?
We also saw some movement in those smaller flex-type units, which lines up with the flex trend we talked about.
Right.
Several deals happened involving parts of Garage Town, USA. That's a big, almost 94,000 square foot complex. These trades were in July and September. Prices weren't disclosed, unfortunately.
But activity there shows continued interest in those smaller, maybe owner-user type spaces.
Exactly. And one more interesting one, 38,075 North Schreiber Way. That's about 17,400 square feet. It traded in July. Completely vacant,
Well,
100% empty.
okay, an investor taking a risk there.
Right, but here's the kicker. The report also lists a major new lease signed at that same address in Q3.
So the buyer likely had a tenant lined up or moved very fast.
Seems like it. It suggests investors are willing to buy empty buildings if they see a clear path to stabilizing it quickly. They're looking past the current vacancy to grab what they see as a good asset or location.
Okay, so capital is cautious, transactions are down, but niche deals and strategic plays are still happening. Let's zoom out to the capital markets snapshot. What are the broader conditions telling us about value and risk in Coeur d'Alene?
Well, first off, valuations are definitely lower compared to nationally. The report estimates the average industrial market price at $110 per square foot.
Okay, and nationally it's...
National average is around $157 per square foot. So Coeur d'Alene is considerably cheaper on a per-foot basis right now.
And if prices are lower, does that mean cap rates are higher, indicating more perceived risk or higher return needed?
That's exactly what we see. The estimated market cap rate for Coeur d'Alene Industrial is 8.6%.
8.6%, how does that compare?
It's significantly higher than the national average, which is around 7.3%. So yes, it suggests investors see either higher risk or, more likely, the higher cost of debt is forcing them to demand a bigger initial return to make deals pencil out.
So you put together the really low sales volume and that high cap rate, it paints a picture of restricted liquidity, especially for bigger deals.
Absolutely. It seems like large institutional money is finding it tough to make deals work right now. The market feels much more reliant on these smaller, maybe necessity-driven owner-user deals like that super high-priced Carissa Court sale.
Okay, so connecting all these threads, what's the outlook? Where does the report suggest things are heading?
Well, tying it all together, the report seems to point towards a slow but steady path back towards normalization. But it really hinges on that demand momentum we saw in Q3 actually continuing.
Right. And the vacancy rate is expected to slowly come down.
Yeah, the forecast suggests overall vacancy might dip to around 5.5% by the end of this year, 2025, and then gradually move back towards that tighter, maybe 3.2% range by sometime in 2028. So a multi-year recovery.
Okay. So based on the report, what are the key things we should be watching heading into Q4 and into 2026?
I think there are 3 main watch items. First, keep an eye on that performance gap between flex and everything else.
Yeah.
Flex rents are stable, even growing. But the report forecasts continued high vacancy, specifically in the larger logistics sector. It mentions 9.7% year-to-date vacancy there. So that divergence is key.
Okay, watch flex versus logistics. What's number 2?
Second, absorption consistency. Q4 really needs to keep up the momentum from Q3. If demand drops off again like it did in Q2, well, that wouldn't reassure anyone that the market's truly turned a corner. We need to see steady progress eating into that inventory.
Makes sense. Confidence needs consistency. And the third thing.
And finally, don't lose sight of the underlying positive. Those long-term economic tailwinds. That robust population growth, 1.7% a year from migration.
Right.
That provides a really strong foundation of demand for industrial space and all the services that use it.
Yeah.
That should help the market weather national economic bumps better than some other places.
Yeah, absolutely. That lack of new construction combined with steady population growth, it really does set the stage for a potentially strong rebound once the capital markets find their footing again, right?
I think so. The underlying demand seems solid. It's just waiting for the financing and development environment to normalize a bit.
So the big question for owners or occupiers listening right now is, how do you navigate this? You've got this short-term inventory available, but this long-term supply crunch coming.
Yeah, it really depends where you sit. If you're in flex, you probably stay confident, maybe even aggressive. If you're in logistics or specialized, now might be the time to think about proactive leasing strategies or even repositioning, trying to lock in tenants while they still perceive they have some leverage.
Good advice. So for anyone needing more specific details or maybe a custom breakdown based on this report's findings,
Mhm.
remember you can contact Eric Peterson directly. That number again is 509-903-9077.
Great. Well, thanks for diving deep with us today. And just a reminder, all this analysis and data came exclusively from the Q3 2025 Industrial Market Report for Coeur d'Alene.